When people hear the phrase stock market, many instantly picture Wall Street traders shouting on the floor, complex charts flashing across multiple screens, or millionaires taking huge risks with their money. And for a lot of beginners, that picture can feel overwhelming, like this world of investing isn't made for them. But the truth is, the stock market is one of the most powerful tools that ordinary people, teachers, small business owners, students, investment, or even someone working a regular 9 to 5 can use to build long-term wealth. You don't need a finance degree. You don't need to start with a huge amount of money, and you don't need to have insider knowledge to begin investment. What you really need is the willingness to start and the patience to let time work in your favor. The stock market matters because it offers an opportunity that savings accounts or simply holding cash cannot match. With inflation steadily eating away at the value of money, putting your cash under the mattress or even in a basic savings account means you're slowly losing purchasing power. The stock market, on the other hand, has historically provided average returns of around 7–10% annually after adjusting for inflation. This means that over time, your money not only keeps up with inflation, but actually grows significantly. If you want to buy a home, retire comfortably, or even just have financial freedom, understanding the basics of the stock market isn't optional. It's essential. Of course, the moment people hear about potential growth, the fear of risk kicks in. And that's completely normal. The idea of losing money can paralyze many first-time investors. Stories of market crashes, bear markets, or friends who lost everything on a single hot stock tip only fuel that fear. But here's the truth. Risk is real, but it can be managed. Losing money is usually the result of not having a strategy, chasing trends, or trying to get rich overnight. On the other hand, when you approach investing with a clear plan and long-term perspective, the ups and downs of the market become less frightening and more like natural fluctuations that you learn to ride out. And this is where the timing factor comes in. Many people spend years waiting for the perfect moment to start investing, thinking they'll jump in once the market dips or when they feel more financially secure. But the reality is there is no perfect moment. The real advantage doesn't come from timing the market. It comes from time in the market. The earlier you start, even with small amounts, the more powerful compounding becomes. Compounding is essentially your money working for you. Over years and decades, the growth accelerates in a way that feels almost unfair. For example, investing just $200 a month starting in your 20s could potentially grow into over $1 million by retirement, while waiting until your 40s means you'd need to contribute far more to catch up. Starting early isn't just better, it's everything. But before you even buy your first share or open your first brokerage account, there's an essential step: preparation. The stock market isn't a casino. It rewards knowledge, patience, discipline. That's why it's important to understand the basics: how stocks work, what diversification means, why fees and taxes matter, and how to align your investments with your personal goals. You also need to ask yourself, what's your risk tolerance? Are you investing for the short term, or is this money meant for retirement 20 or 30 years from now? Without this groundwork, it's easy to get lost, panic during downturns, or jump into the wrong investment. But with the right foundation, you'll not only avoid costly mistakes, you'll actually feel confident every time you put your money to work. So getting started in the stock market isn't about being fearless or having a fortune. Investment or predicting the next big thing. It's about understanding why the market matters, overcoming hesitation starting as early as possible, and preparing yourself with the right mindset and knowledge. Once you do that, you'll see that investing isn't reserved for Wall Street professionals. It's a path open to anyone who's ready to take control of their financial future. The stock market is often misunderstood as something reserved only for the wealthy, financial experts, or people who are already deeply involved in the world of money. But in reality, the stock market is one of the most important financial tools available to everyone, no matter where you come from or how much money you start with. It matters because it provides ordinary people with an opportunity to grow their wealth in a way that no savings account, paycheck, or traditional method of storing money can match. The idea is simple: by owning a piece of a company through shares, you're participating in the growth and profits of that business. When the company performs well, you benefit. When the economy grows, you benefit. And when time compounds these returns, your future self benefits in ways that can be life-changing. Investment. For many people, the biggest financial challenge they face isn't about how much they earn, but how well they manage and grow what they already have. Think about it this way: working hard at a job provides income, investment, but it's usually linear, trading your time for money. If you stop working, the income stops. The stock market, however, introduces a different element: exponential growth through compounding. This is why it matters so much. By consistently investing over time, even small amounts, your money starts working for you. Instead of you earning every dollar through labor, your dollars start earning more dollars on their own. Investment. That shift from depending solely on earned income to leveraging investment income is what creates long-term financial stability and eventually financial freedom. Another reason the stock market matters is its ability to outpace inflation. Investment. Inflation quietly eats away at the value of your money every year. That 100 you hold in cash today won't buy you the same amount of goods or services 10 years from now. If your savings sit idle in a low interest bank account, the purchasing power of that money erodes over time. But when you invest in the stock market, you're putting your money into assets that historically have grown faster than inflation. Over the long run, stocks have returned about 7-10% annually after accounting for inflation. This means that not only does your money maintain its value, it actually grows and gives you more options for the future. Without this growth, financial goals like buying a house, sending kids to college, or retiring comfortably become harder to reach. The stock market acts as a protective shield against the silent threat of inflation. It's also worth recognizing that the stock market isn't just about individuals, it fuels the economy itself. When you invest in a company by buying its shares, you're helping fund its ability to innovate, hire, expand, and create products and services. In return, as the company succeeds, your investment grows. This relationship ties everyday investors directly to the progress of businesses and industries that shape our lives. For example, when technology companies grow and create new innovations, investors in those companies benefit from that growth. In this sense, the stock market allows people to participate in the larger story of economic growth investment, not just observe it from the sidelines. A common misconception is that investing in the stock market requires a huge amount of money to begin. That's simply not true anymore. With today's technology and the availability of fractional shares, anyone can start investing with as little as a few dollars. This democratization of investing makes the market more important than ever because it removes barriers that once kept ordinary people from accessing the same opportunities as the wealthy. By starting small, learning as you go, and staying consistent, anyone can use the market to their advantage. This means that whether you're a student, a teacher, a mechanic, or a business owner, the stock market offers a level playing field where everyone has a chance to grow wealth over time. Beyond money itself, the stock market matters because of what it represents: freedom and security. Financial freedom doesn't mean being rich. It means having choices. It means not worrying about whether you can pay your bills if an emergency arises. It means being able to retire without fear of running out of money. It means giving your kids better opportunities or being able to travel, or even just sleeping better at night, knowing your future is secure. The stock market, when approached wisely, offers a pathway to those outcomes. It's not a guarantee because risk is always involved, but it's one of the most reliable ways to build wealth over decades. Of course, it's important to point out that the stock market isn't magic. Investment. It's not a place where money doubles overnight, and it's not a shortcut to riches. People who chase quick gains or speculate without understanding what they're doing often end up losing money. But when used correctly, the market becomes less about speculation and more about discipline. It's about regularly contributing, diversifying, and letting time do the heavy lifting. The fact that you don't need to be an expert to take advantage of this system is precisely why it matters so much. With access to basic information, simple investment platforms, and patience, anyone can participate. Investment. When you step back and look at the bigger picture, the importance of the stock market is undeniable. It's not just about numbers on a chart or lines going up and down. It's about what those numbers represent in your life. They represent the ability to retire earlier, to provide more for your family, to take control of your time, and to stop depending entirely on work for survival. They represent financial independence, which at its core, investment is the ability to live life on your own terms. This is why the stock market matters for everyone. It's not a playground for the rich, nor is it a gamble for the lucky. It's a proven system that rewards knowledge, patience, and consistency. The earlier you understand this, the faster you can start making decisions that align with your long-term goals. And while it may seem intimidating at first, the reality is simple. The stock market is one of the most powerful equalizers in personal finance investment, offering every person, regardless of background, the chance to build the future they want. Fear is one of the most powerful emotions that can hold people back from taking action, especially when it comes to investing in the stock market. For many beginners, the idea of putting money into stocks immediately triggers anxiety. Thoughts like, what if I lose everything, or I don't understand this, so I shouldn't do it, are common, and they're completely normal. After all, when you're dealing with your hard-earned money, the stakes feel real, and the possibility of loss is frightening. But here's the important truth. Fear is not a reason to avoid investing. It's a signal to prepare. Educate yourself and develop a strategy that reduces risk. Overcoming that fear is one of the most important steps toward long-term financial growth because hesitation and inaction can cost far more than a carefully managed investment ever could. Most fear stems from the unknown. People see news headlines about stock market crashes, bear markets, or friends who lost money on investments, and they naturally assume that investing is inherently dangerous. But risk and uncertainty are not the same thing. Risk is measurable and manageable. Uncertainty is simply the lack of knowledge. When beginners take the time to understand how the stock market works, the apparent danger diminishes. Learning about diversification, compound growth, and long-term strategies can transform fear into confidence. The market is not a place for guessing. It's a system where consistent, informed decisions lead to predictable outcomes over time. Understanding the mechanics removes the illusion that investing is a gamble, replacing it with a sense of control. Another major reason people hesitate is the fear of loss. Nobody likes losing money, and the stock market, by its very nature, experiences ups and downs. Seeing the value of your investments drop can be emotionally challenging, but it's crucial to recognize that temporary declines are a normal part of the investing process, not a permanent failure. Every long-term investor experiences market fluctuations. The key difference is perspective. Instead of viewing a market dip as a disaster, it can be seen as an opportunity to buy quality assets at a lower price. Over time, investment. The market historically recovers and grows, meaning short-term losses are often irrelevant when you have a long-term strategy. Fear diminishes when you understand that investing isn't about short-term wins. It's about building wealth steadily over years and decades. Fear is also amplified by misinformation and myths about investing. Many beginners believe that investing requires a large sum of money, insider knowledge, investment, or complex financial strategies. This perception makes the stock market seem intimidating and exclusive. But in today's world, technology has removed most of these barriers. Anyone can start investing with small amounts, access educational resources online, and even invest in fractional shares of high-priced stocks. Learning the fundamentals and gradually building knowledge helps overcome the fear caused by misunderstanding. But knowledge doesn't eliminate risk completely, but it equips you to make smarter decisions and reduces anxiety about the unknown. Another effective way to overcome fear is by focusing on what you can control. You cannot predict the market or guarantee immediate returns, but you can control your approach, the amount you invest, the strategy you choose, the diversification of your portfolio, and your commitment to long-term growth. By concentrating on factors within your control, fear becomes manageable because you're no longer obsessing over unpredictable outcomes. You're acting deliberately with a plan instead of being paralyzed by uncertainty. The discipline of following a structured plan turns fear into confidence. It's also important to address the psychological component of fear. Emotional reactions to market fluctuations often lead beginners to make mistakes. Investment, such as panic selling during a dip or chasing hot stocks. These actions usually result in losses and reinforce fear, creating a cycle of hesitation and regret. Learning to manage emotions, maintain perspective, and stick to a long-term strategy is critical. Many successful investors will tell you that the difference between those who succeed and those who fail isn't intelligence, it's emotional discipline. Overcoming fear is largely about training yourself to stay calm, think logically, and avoid reactive decisions. One practical way to conquer fear is to start small. You don't need to invest a large sum of money immediately. Investment. By starting with a manageable amount, you gain hands-on experience without risking financial security. As you see your investments grow over time, confidence builds and fear naturally diminishes. Each small success reinforces your understanding and comfort level, making it easier to scale your investments gradually. Finally, remember that fear is universal, and even experienced investors feel it at times. The difference is that they don't let it dictate their actions. They recognize that short-term fluctuations are normal, that risk can be managed, and that long-term planning is more important than reacting to every market movement. Overcoming fear isn't about being fearless. It's about acknowledging fear, understanding it, and making informed decisions despite it. Once you achieve this, investing becomes less intimidating and far more rewarding. Investment. Fear may always exist at some level, but knowledge, preparation, discipline, and a long-term perspective transform fear from a paralyzing force into a motivating one. The sooner beginners embrace this mindset, investment, the sooner they can start participating in the stock market with confidence, turning hesitation into action and potential into growth. When it comes to investing in the stock market, timing is often overemphasized. Many beginners spend months or even years waiting for the perfect moment to start when the market is low, when the economy is stable, or when they feel financially ready. But the truth is, investment. The most important factor in building wealth through the stock market isn't timing. It's time itself. The sooner you start, the more you benefit from the power of compounding, the most powerful force in finance. Time in the market consistently outweighs attempts to time the market, and understanding this concept is critical for anyone looking to grow their wealth steadily and reliably. Starting early gives your investments the advantage of compounding. investment, which is essentially your money earning returns, and those returns earning even more returns over time. Think of it like a snowball rolling down a hill. At first, the snowball is small and the growth is slow, but as it continues rolling, it gathers more snow, picks up speed, and eventually becomes massive. The stock market works in a similar way. For example, if you invest a $200 per month starting at age 25, assuming an average annual return of 8%, by the time you reach 65, your investments could grow to over 600,000. Now imagine starting the same $200 per month at age 35 instead. By retirement, you might end up with less than half that amount. And the extra 10 years of investing early allows compounding to do far more work than your additional contributions later in life ever could. Time amplifies growth, and starting early maximizes this advantage. Another reason starting early is so important is that it allows you to take more risk comfortably. Younger investors have the benefit of time to recover from market fluctuations. If the market experiences a downturn, a 25-year-old has decades to ride out the volatility, whereas someone closer to retirement may not have the luxury of waiting for a recovery. This means that starting early allows you to invest in higher growth assets like stocks, which historically offer higher returns than bonds or cash without the same level of pressure or stress. You can afford to take calculated risks because you have time on your side. Conversely, delaying investing often forces people into safer, lower return options that can significantly slow wealth accumulation. Starting early also helps build a habit of consistent investing, which is as important as the investments themselves. When you begin investing in your 20s or early 30s, contributing even small amounts each month becomes second nature. This discipline carries forward for decades, turning consistent contributions into substantial wealth over time. Those who start later not only miss out on compounding, but also often struggle to make investing a routine habit because they feel pressured to catch up or invest large sums at once, which can be stressful and difficult to sustain. The habit of investing early cultivates patience, consistency, and a mindset focused on long-term growth, qualities that are critical for financial success. The importance of starting early also extends to learning and experience. The stock market isn't just about money. It's about education and decision-making. Investing early allows beginners to experience market fluctuations firsthand, learn how to manage risk, and develop confidence in their investment strategies. Making small mistakes in your 20s or early 30s can be valuable lessons that prevent larger errors later. In contrast, starting late often leaves less room for learning and fewer opportunities to recover from mistakes, which can magnify stress and reduce long-term returns. Early experience builds knowledge, emotional resilience, and confidence, three components that are just as valuable as the money invested. Moreover, starting early aligns perfectly with long-term financial goals such as buying a home, funding children's education, or building a retirement nest egg. By beginning early, even modest investments can grow into significant sums, making these goals more achievable. Delaying the start often means these same goals require much larger contributions or sacrifices later, creating financial strain and reducing flexibility. Time gives your money the chance to grow while you live your life and focus on other priorities. It's also worth noting that starting early doesn't require a perfect financial situation. Many people believe they can't invest until they have a large emergency fund or a high-paying job. In reality, even investing small amounts consistently is better than waiting for the perfect moment. The earlier you begin, the more you benefit from years of growth, even if the contributions are modest at first. Over time, as income increases, contributions can increase as well, but the key is to start without delay. Ultimately, starting early transforms investing from a daunting challenge into a manageable and highly rewarding process. It gives you the advantage of compounding, allows you to take calculated risks, builds consistent habits, provides valuable experience, and aligns your investments with long-term goals. Waiting for the perfect time only delays wealth accumulation and often reduces options later in life. Time is the investor's most powerful ally, and the sooner you harness it, investment, the greater the potential for financial independence, security, and freedom. The lesson is clear: starting early isn't just beneficial, it's essential. Every day you delay investing is a missed opportunity for growth, experience, investment, and compounding. The sooner you take action, the sooner you put time to work in your favor, and the closer you move toward achieving the financial life you desire. Starting early turns investing from a hypothetical concept into a real investment, tangible pathway to wealth. Before anyone invests a single dollar in the stock market, there's an essential step that many beginners overlook: laying the groundwork. Jumping straight into buying stocks without preparation is one of the quickest ways to encounter mistakes, stress, and unnecessary losses. Laying a proper foundation is about more than just understanding stock prices or market trends. It's about building knowledge, setting financial goals, understanding risk, investment, and cultivating the mindset needed to navigate the inevitable ups and downs of investing. Without this preparation, even well-intentioned investments can lead to frustration rather than growth. The first part of this groundwork is education. The stock market may seem complex at first, but its basic principles are understandable once broken down. Understanding what stocks are, how companies generate profit, and how stock prices fluctuate is fundamental. Beyond individual stocks, investors need to understand concepts like index funds, ETFs, diversification, and the difference between short-term speculation and long-term investing. Financial literacy is a shield against poor decisions, investment, and the more knowledge a beginner acquires, the more confident they become. This learning phase is not about memorizing charts or trying to predict market moves. It's about building a foundation of understanding that allows informed investment, deliberate choices. Next comes the critical step of setting clear financial goals. Every investment decision should have a purpose. Are you investing to buy a house in 5 years, to build a retirement fund for 30 years down the line, or to generate supplementary income? The answer to that question shapes the type of investments you choose, the level of risk you can take, and the strategy you follow. Without defined goals, investing can feel directionless, and it becomes easy to chase trends or make emotional decisions during market swings. Clear goals create a roadmap and allow for strategic planning, which reduces anxiety and gives structure to the investing journey. Investment. Understanding risk is another essential aspect of laying the groundwork. All investments carry some degree of risk, and the stock market is no exception. Beginners often underestimate the fact that volatility is normal and that losses, especially in the short term, are part of the process. Risk tolerance varies from person to person, influenced by factors such as age, financial responsibilities, income stability, and emotional resilience. Assessing your own comfort level with risk before investing prevents panic selling during market dips and helps in creating a diversified portfolio that balances potential returns with peace of mind. Diversification, spreading investments across sectors, industries, and asset types, is a practical method of risk management, and understanding it is a key part of preparation. Another component of groundwork is having a strong financial foundation outside of the stock market. Before investing, it's essential to have an emergency fund in place to cover at least 3 to 6 months of expenses. This ensures that unexpected costs don't force you to sell investments at a loss. Paying down high interest debt, such as credit cards, is equally important because the interest on can outweigh potential investment returns. By stabilizing your finances first, you create a safety net that allows you to invest with confidence and focus on long-term growth rather than short-term survival. Mental preparation is just as important as financial preparation. Investing can be an emotional roller coaster, especially for beginners. Markets fluctuate daily, and it's easy to get caught up in fear, greed, or impatience. Establishing a mindset that embraces patience, discipline, and long-term thinking is critical. This involves accepting that losses are temporary, gains take time, and staying the course is often the best strategy. Investors who cultivate the right mindset avoid impulsive decisions and are far more likely to achieve consistent results. Mental discipline turns investing from a stressful activity into a systematic process for wealth building. And practical preparation also includes choosing the right tools and platforms. Today, there are countless brokerages and investment apps, each with their own fee structures, account minimums, and features. Understanding the differences, comparing costs, and selecting a platform that aligns with your needs ensures smooth execution and reduces frustration. Additionally, familiarizing yourself with account types, tax implications, investment, and basic investment strategies sets the stage for confident, informed decisions. Finally, laying the groundwork means developing a strategy. This isn't about predicting which stock will double tomorrow. It's about creating a clear plan for how and when you will invest, how you'll allocate assets, and how you'll adjust your strategy as circumstances change. A well-defined strategy provides structure, reduces emotional decision-making, and allows you to measure progress over time. Without a plan, investing becomes reactive rather than proactive, and the risk of mistakes rises dramatically. In conclusion, laying the groundwork before investing is about preparation in every sense: financial, educational, strategic, and emotional. It ensures that your investments are purposeful, aligned with your goals, investment, and managed in a way that balances risk and reward. This preparation transforms investing from a guessing game into a deliberate process for building wealth over time. By investing in your knowledge, assessing your risk, establishing a strong financial foundation, cultivating the right mindset, and creating a structured strategy, you put yourself in a position to not only enter the stock market confidently, but to thrive in it. Without this groundwork, even the best investment opportunities can become sources of stress and regret, but with it, investing becomes one of the most effective tools for achieving long-term financial security and freedom.